Most Americans lose more than $14,000 a year to just 5 so-called smart money moves. And it is not because they are reckless, serious. It is because the system is engineered that way. If you've ever tightened your budget, cut out lattes, shopped for deals, and still wondered, why am I never ahead? This video is for you. Recent data from Forbes shows that everyday expenses like debt, subscriptions, and hidden banking fees drain the average household far faster than you realize. Today, I am not only going to reveal the 5 biggest wealth traps silently siphoning your net worth each year. I will show you exactly how much they are taking from you, who is on the receiving end, and the step-by-step playbook to finally turn the tables. Stick with me, and by the end, you will know how to audit your own finances to stop funding someone else's fortune. Welcome to Jim Invests. Let us stop playing by invisible rules and start uncovering exactly how everyday choices can leak money out of your life and what to do instead. Here is our roadmap. I am going to walk you through the 5 wealth extraction traps, the hidden pipes in your financial house, quietly shifting your hard-earned cash into other people's pockets. With every trap, I will show you the latest numbers, cite real sources, and give you a clear, actionable way to cut the leak. Ready to find out if you are funding someone else's fortune? Let us jump in. Trap 1 of 5. The credit card consumption cycle. Americans pay over $120 billion a year in credit card interest and fees. Appalled, even if you pay off your card every single month, you are still part of this profit pipeline. Here is why. Every time you swipe, merchants pay fees up to 3%. Which get bundled into the cost of goods everywhere. Next time you think your rewards program is a bonus, remember, it is funded by other people, carrying balances at up to 20% interest. But it does not stop there. The more you use your card, the more data companies collect about your spending. Last year, U.S. credit card companies generated an estimated $46 billion just from personal data, sales, and targeted advertising. Behind every points offer and app notification is a psychological engine built to nudge you towards more purchases. The cycle. You spend, they profit from fees and data. You see more targeted ads. You spend again. I call it the consumption amplification loop. Let us put real numbers to this. Imagine you spend $2,000 a month on your credit card. Across 12 months, that is $24,000. And at just a 2.5% average merchant fee, you have indirectly incurred $600 in annual fees built into the prices you pay. That does not count interest if you ever carry a balance, even temporarily. At the U.S. average APR of 20.68%, a $4,000 balance costs you $827 a year in interest alone. All of this flows upward from your wallet to banks to shareholders. Ask yourself, when was the last time your responsible credit card habit actually improved your last wealth instead of someone else's? If you have ever been burned by interest or hidden fees, drop a comment below. Let us see how common this trap really is. How do you escape this cycle? First, if you use cards for convenience, always pay the full balance. Never use for anything you could not cover with cash today. Next, audit every active card on your credit report. Cancel any that you do not need, and freeze your lines against new offers. Finally, opt out of data sharing where possible. It will not stop all targeting, but it reduces your value as a commodity. Remember, the only truly free rewards are those you would earn using cash anyway. But the next trap is even sneakier. It is the one you have been told is a good move. The Great Savings Account Illusion. Trap 2 of 5. The Savings Account Squeeze. Here is the deal. According to Bankrate's 2023 survey, the average U.S. savings account yields just 0.45% APY, while inflation in 2023 ran above 4%. That means every $10,000 you keep safe in a standard account actually loses $355 a year in real spending power. Banks take your deposits and lend them out at 5%, 15%, sometimes even 20%. That is how they can offer mortgages, auto loans, and business credit lines. A process called fractional reserve banking. The difference between what they pay you and what they earn, the spread, is pure profit. On your $10,000, the bank can make $500 or more per year from loans while paying you just $45. The system counts on most people never checking better rates. Emergency fund? Great idea. But if you are leaving it in a 0.4% account, you are letting inflation slowly siphon your buying power. Let us visualize. Over 10 years, your safe $10,000 could erode to the equivalent of just $6,550 in today's money if inflation averages 4% and savings rates do not catch up. $10,000 times open parenthesis 1 minus 0.04 close parenthesis 2. The 10th power is approximately $6,550. So, what is the fix? Helpful first. Always compare online-only banks and credit unions. Right now, high-yield savings accounts offer up to 4.5% APY. Second, periodically move your cash to chase better rates, even if it takes some paperwork. Third, keep only your absolute emergency fund in cash. The rest should be working harder for you. Do not hand the bank a free loan with your money. Here is a wake-up call. Every dollar you think you are saving could be making someone else richer. Next up, we hit trap 3. And this one quietly drains even the sharpest budgeters. The subscription sabotage. Trap 3 of 5. Subscription sabotage. Did you know the average American household now pays for 12 recurring subscriptions and spends $273 a month on them? That is $3,276 a year, and over 10 years, nearly $33,000 before accounting for price hikes. Companies love the just $10 per month model because it feels painless. But those little numbers pile up faster than you realize. Behind every subscription is a psychological trick. The friction to sign up is low, but the friction to cancel is high. Add on free trials, loyalty perks, and frequent auto renewals. And it is no wonder people forget what they are actually paying for. Here is a powerful hack. Take 1 hour this week to open your banking or credit card app and list every recurring charge. Mark each as essential, nice to have, or unnecessary. Cancel everything that does not bring you real value. To make this foolproof, set recurring calendar reminders every 90 days. Use tools like Truebill or Rocket Money to track subscriptions automatically. Let us do the math together. Even cutting 2 $15 per month subscriptions frees up $360 a year. If you invested that at a historic average market return of 7% for 20 years, it could grow to $15,157. Use this formula. Future value equals payment times open parenthesis 1 plus R. Close parenthesis to the power of n minus 1, close parenthesis, divided by r. Here, $360 times open parenthesis 1 plus 0.07, close parenthesis, to the 20th power, minus 1, close parenthesis, divided by 0.07, equals $15,157. Small leaks have massive long-term consequences. If you have ever opened a statement and said, "Wait, I'm still paying for that?" type TRAP in the comments. Let us see how many of us have been caught here. And trust me, Trap 4 is not any prettier. Your car might be your biggest financial landmine. Trap 4 of 5, the car payment black hole. That is the average new right now, just for the privilege of ownership. And that is before insurance, maintenance, or gas. Here is where the wealth transfer comes in. Once you drive off the lot, your vehicle drops 20 to 30% in value instantly. 5 years in, the typical car lost 60% of its value. Yet, you are still making payments based on the original sticker price. That depreciation is your money, gone forever. Dealers and lenders win, you lose. And it does not end there. More cars now collect and sell data about your habits, where you drive, how fast, how often. This data stream is worth billions per year to insurers and advertisers. When your insurance company offers a discount for plugging in a tracker, remember, they are banking on collecting detailed risk data, not just rewarding safe drivers. So what is the antidote? The ideal is paying cash for reliable, used vehicles and keeping them as long as possible. If you must finance, shop for the shortest term you can truly afford. And never let them talk you into rolling negative equity forward. Bonus: calculate the true 5-year cost, including insurance, depreciation, and extras. Do not just look at the monthly, and always compare insurance quotes before you buy. If this is opening your eyes, hit subscribe or share this video. Help a friend dodge a $50,000 mistake before Trap 5 takes another chunk out of their future. Trap 5 of 5, the mortgage and housing labyrinth. Now we reach the trap no one thinks they will fall into: your home. For most Americans, it is their largest asset and often their largest net worth drain. Here is how. The median new mortgage in America is about $2,200 per month. Over 30 years, that $300,000 house usually costs closer to $600,000. Thanks to interest. The structure of most loans front-loads the interest, meaning for the first 5 to 10 years, much of your payment goes straight to the bank's pockets, not your equity. But there is more. If you do not put down 20%, you are often forced to pay private mortgage insurance, an extra $100 to $200 per month, just to protect the lender. Add in closing costs, typically $5,000 to $15,000, which pay for title insurance, origination and processing fees. And you quickly realize buying a house is a transfer of wealth to multiple middlemen long before you ever build any equity yourself. And do not forget homeowners insurance, up 22% year over year, with many policies stuffed with exclusions for events you thought were covered. So how can you fight the trap? Helpful first, before buying, run the full 30-year calculation yourself. Use an online calculator and see both the total cost and interest paid. Next, shop lenders obsessively. Tiny rate reductions can save you tens of thousands. Third, put 20% down if possible to avoid PMI. Finally, build up a maintenance fund and read every insurance policy word for word, especially the exclusions. A quick quotable: The most costly money mistakes usually hide in plain sight, especially when the papers say you are being responsible. Now, before we wrap up, let me ask, did any of these traps surprise you? Comment which one hit hardest. And as promised, here is how to take action and claim back your wealth. Action plan. The 5-step wealth trap audit. Make a list of every credit card, loan, and recurring subscription. Note how much you pay annually. Compare your main savings account rate to competitors. Switch if you are under 2% APY, unless you need instant access for emergencies. Audit your car costs. Calculate total payments, yearly depreciation, insurance, and all extras. If you are upside down, build a 2-year payoff plan. For housing, sum up your total 30-year cost, count all closing costs, and check your homeowner's insurance for hidden exclusions. For each category, ask, if I eliminated or reduced this by 20%, where could I invest or grow my wealth instead? To make this easier, download my free Wealth Trap Audit Checklist. It will walk you through each step with space to write out your numbers and identify hidden leaks. Want to spot traps in your wallet right now? The checklist is waiting for you in the video description. Before we close, here is one last preview. Many of you are wondering, if I stop these leaks, where should my money go instead? Next video, I will break down the 3 highest leverage places hardworking people can actually build wealth with full math, risks, and real-world results. Subscribe so you do not miss it. Remember, this content is for educational purposes only and should not be considered specific financial advice. Sources for all statistics are provided in the video description. Let us bring this home. Today, you've seen how 5 smart money moves can siphon over $14,000 a year from that average household. Not because you are reckless, but because the system is designed that way. You learned exactly how credit cards, low-yield savings accounts, sneaky subscriptions, oversized car payments, and mortgage costs silently transfer your potential wealth into the hands of banks, corporations, and lenders. Here is what you can do right now. Download the Wealth Trap Audit Checklist in the description and start filling it out today. Review every account, every subscription, every hidden fee. Set a reminder for 30 days from now to check your progress. See how much you want. Have stemmed the leak. Over the next 6 to 12 months, use this checklist as your recurring audit tool. Each quarter, optimize one trap at a time. Switch to a better savings rate, negotiate a bill, pay off a credit card, or finally drop the subscriptions that do not actually add value. In a few weeks, you should start to notice lower expenses and more leftover money at month end. In a year, this audit process can reclaim thousands and give you the confidence to redirect funds toward your grace own future. It is not about perfection. It is about gradual, lasting change. Subscribe and turn on notifications, because next time I will reveal the 3 highest leverage wealth builders for everyday people. With numbers, risks, and step-by-step guides you can start immediately. And do not forget, download your Wealth Trap Audit Checklist below. Share this with any friend who is ready to flip the game. This content is for educational purposes only and should not be considered specific financial advice. Sources for all statistics are provided in the video description. For decisions regarding your personal finances, consult a licensed financial advisor.